Boa tarde a todos, sou Roberto Attuch, CEO da Home Research. Hoje eu tenho a honra de ter aqui duas feras e a gente vai falar sobre o que é o principal tema de investimento da próxima década, que é a descarbonização do planeta, a transição energética. E hoje, quer dizer, a gente vai falar disso aí relacionado com commodities. Então, vamos falar do mercado de commodities, quais commodities se beneficiam mais da transição energética. Então, enfim, eu vou moderar o debate. A gente tem aqui hoje o Felix Bouderaut, ele é sócio da SMS, Sustainable Market Strategies, que é uma consultoria de ponta, líder em ESG. Eles fazem realmente estudos temáticos bem profundos, contribuidor da Home Research também. E eu tenho o Gilberto Cardoso, que é uma autoridade em mineração e siderurgia, trabalhou muito tempo no sell side, mas ele é um veterano da indústria também. Mais recentemente, ele estava na ArcelorMittal em Londres, mas também já trabalhou na Vale, na BHP. Então, eu vou passar rapidamente para o Gilberto, ele faz uma introdução, e aí depois a gente volta com o Félix vai fazer uma apresentação que ele tem preparada sobre commodities. Só lembrando, a live vai ser em inglês, mas vocês podem fazer perguntas tanto em inglês como em português, que a gente responde. Então, obrigado mais uma vez, eu passo para o Giba, ele faz a pequena apresentação dele.
Okay, Roberto, thank you very much. Felix as well. I'm very happy to contribute here a little bit on metals and mining, specific on ferrous metals and new minor metals as well. I think my ideas, they are a little bit flashing on the very early report from an international agency that produced a very interesting report for net zero by 2050. And they flag a lot the importance of the new commodities or the critical minerals or materials. They're going to be needed by 2050. And they are mostly driven by copper, lithium, cobalt, and all the material metals. They're going to be driving that, nickel, manganese as well. And they're going to be quite booming from the demand side. I pick up some kind of interesting numbers. I think they are forecasting that the demand for these specific critical materials are going to be increasing by 5-fold. So these kind of critical materials like nickel, manganese, lithium, cobalt, they're going to explode. And a lot of projects must be induced for them to come on stream, and then the demand meets the supply. That's for me, that's the big driver for these commodities. I'm very bullish about that, not only from these critical materials, but also looking a little bit on the ferrous materials. So steel, iron ore, of course, coke, going to be a lot of depression on that, but iron ore and steel going to be required to build the renewable. So just for kind of examples, roughly 90% of the renewables focus on the wind farms and the windmills. They are based on weight, 90% on steel. And this steel must be produced by a net zero, also carbon from that. And then you have to change completely the steel supply chain and also production line. So we are moving towards from sintering, blast furnace operation using coke, for more hydrogen-based electric arc furnace, melted scrap, or high-grade pellets. So I think we're going to see a massive transition, and we're going to probably discuss later which kind of commodities and suppliers, countries, are going to be benefit on that. So that's my introduction about the metals and mining, in my view.
Thanks a lot. Is it so? I'll take it right from where you left. I think it's a very good introduction, and we're very aligned. I think on how we think about the sector and the prospect for the sector. So first of all, I'm Felix Bouderaut. I'm a founder of Sustainable Market Strategies, as Roberto said. And also, I want to thank Roberto for inviting us, and it's an honor to share virtual stage with Gilberto as well. And so I have a few slides. I'll try to share my screen. You let me know when you can see it. And just one second. I'll try again. There you go. Let me know when you can see it.
Yep.
Great. So I'll go full screen here, and then let's dive right in. So first of all, a quick note on myself and on our firm, maybe very quickly. This is not an infomercial, but it helps to put everything in context. So myself, I'm an engineer by training. I also have an MBA, and I worked for quite a long time on climate change policies for the government of Canada, amongst others. And I was the director of the international negotiations for climate change in the lead up to the Paris Agreement. I then worked for IFC and OECD and other international organizations on the opportunities that the transition to a low carbon economy are generating. So this, the theme of today fits right in that field. And we, with a partner, we founded Sustainable Market Strategies in 2018 to give really investment ideas to our clients who are asset managers, asset owners for the most part. They cumulatively manage over 4 trillion, and they are among some of the top investors in the world. And every week we challenge ourselves to produce innovative, cutting-edge research on thematics. And so, as you can expect, in the 150 notes that we've published already, there are quite a number of them on the topic of, the transition, which sector will have tailwinds, others headwinds. And so we obviously tend to always come back to this theme of transition, right? And as Gilberto was saying, the most recent report by the IEA really, I think, shook a little bit the world in the sense that the IEA is not an environmental NGO. Let's be clear. They are extremely serious economists and energy specialists, and yet they made claims that could be mistaken for claims from the WWF or others. Stuff like no new oil and gas projects can come online if we want to meet the net zero target by 2050, which is fairly a strong statement that was opposed by already some OECD members like Japan and Australia, and I'm expecting Canada to react at some point. But it really was a bit of an alarm to some people to say, like, if the IEA is really saying that, it's something serious. So this is their plan for decarbonization. As Gilberto was saying, it's very aggressive. It has extremely tight timelines. And so this will, as we move forward on this time scale, it will really require a lot of new ways of building stuff and on, transmitting energy. And so this comes down a bit to the topic of today. The net zero trend is extremely strong and has a big tailwind, and we expect more to come in the lead up to the COP26 in Glasgow at the end of the year. And so already we have more than half of the world's GDP that has, in a way or another, committed to net zero by either 2050 or 2060. And so very aggressive. And this really led, had to force the industry to react. And so a lot of companies are doing the same. And then obviously that leads to a lot of, transition work. And one important thing, and Gilberto mentioned it quickly, is that there are some extremely important geopolitical impacts to this, because on the top here you have what oil and gas used to be. So it was your usual suspects were the big, very fairly not that concentrated production. There was quite a number of players, but a concentrated consumption. Whereas now we're looking at a fairly concentrated mining and processing of the new metals, the transition enabling metals, let's call them, and they are not your typical countries that the developed world was used to deal with. And so that will really lead to some interesting dynamics. And you can see already President Biden is actively looking to make some strategic alliances with some of the countries on the left side here. We will talk about this, so I won't spend too much time. But and Gilberto mentioned it, but it's the demand for these new metals will be extremely strong. And so you can see on the left, the bottom left here is a chart from McKinsey & Company, and you can see that strong tailwind for copper, coal obviously going to zero, lithium has a lot of tailwind. And then in iron ore, and I'm looking forward to discussing with Gilberto, but there is obviously an increased demand for some of the infrastructure that is needed, but there is also a lot of progress being made on the recycling of some of the existing stock, and so that might actually put some downward pressure on the primary producers. So I'm looking forward to discussing this. Gilberto was saying 5 times more. Well, it can be for lithium there. Some projections are expecting almost 40 times what the current demand is, and so it's on average is most likely between 5 and 10 times more for a lot of those minerals and metals. And there are existing. These are just the names of some of the companies that are involved in this. I will talk a little bit about this a bit later because we did some research a bit on this. But there are other ways to be invested in this theme without touching some of these names that sometimes come with a bit of a downside as well in terms of how mining is a dirty business for lack of a better word. And that one emerging commodity that we can also maybe touch on a bit later in the discussion is carbon. So if we consider carbon as being a commodity, because it's being traded in Europe, it will start very soon to be traded in China, then it would have been the hottest commodity in 2020, and it really had a roaring start of 2021. So this is also something that we look very closely at, and it really opens a brand new investing class. And actually, we've written notes on that as early as 2018. We were talking about the carbon comeback. That was at 16 euros at the time. It's now well over 50 euros now. And then we've written in just this past December on the fact that it's really becoming an asset class on its own, with hedge funds being invested, speculators, playing it, etc. And again, to talk about a bit the research that we do, last fall, we've written quite a bit about the decarbonization commodities, and how an investor can find a way to be, a proxy maybe to be investing in gold, because gold is a difficult asset class for an ESG investor. But there are companies that are specialized in the recycling of the metals, and we think it's a smart way of addressing this. So I have a chart here with some of the names. I'm not sure it's readable, but the top line here is a company called Sims in Australia that does a lot of metal recycling, and we believe that's going to be a very strong area, because there's some pressure on primary extraction for obvious environmental, social, and governance reasons. And so there will be a lot of demand for the circular economy around minerals and metals. And so companies like Sims, like Boliden, like Arubis, like there are a number of companies. And then you can see very quickly the second line here, light blue is the carbon, how the carbon did in the last 6-7 months, so more than doubled. Then copper did extremely well again. And in one of our notes, we put we kind of pitted against copper against iron ore, saying that we believe the demand for copper would be stronger than the demand for iron ore, which might actually at some point peak. And so based on that, we were right anyways for the first in the last six or 7 months, because you can see that iron ore is around here, and so there's a good alpha here. And that's it for my quick presentation, because I'm really more interested in the discussion and the questions from the people attending.
Yeah, no, it's great. So we already have a few questions, and I'll give the first one to Gilberto, but you can answer as well. And I guess the other one I have here is more directed to you. But there's a question from Otaviano Canuto, who's a very well-known professor in Brazil. He's saying that not a single big project in copper has been announced for some time now, and he's asking if scrap copper may be used to dampen the price hike. I mean, I'm not an expert in the industry, so what's your view on that? And also, if you could comment, Gilberto, on how do you see the supply being increased in copper? I mean, I've seen some news recently about people in Chile saying that some rules, environmental rules related to a glacier, they may constrain Codelco's output by 40%. So I mean, how you see that playing out?
I think the name of the game is going to be the copper content. So the copper content in mine is now in Chile. If you pick up Codelco and Escondida, that is run by BHP, the percentage of the copper content is dropping every year. So they have to mine more, remove more earth to produce less copper. Yeah, that's the name of the game. And they have to expand. They have to find new projects to either balance out this copper content to maintain at least the same level of production of the metal concentration. So that's one of the problem. Yeah. The second problem is some of the mines, they still have problems with water supply. I know that BHP invested a lot to do kind of desalination of the water, recycling of the water to produce the same amount of copper in Escondida, and they try to maintain. So if you are looking for a massive increase on demand, so we have to find new deposits, we have to induce new projects. And inducement costs of this long term on the cost curve for copper, they have to be applied. So if now we are trading at $10,000 a ton of copper, yeah, and some projects they have at least to be around 15, 20,000, 30,000 to be on the cost curve, even of course in fourth quartile of the cost curve, but they have to set the price. So if you look at this perspective, and also as important to know, and because the recycling, I'm also a big fan of that. But if you do the mass balance, there's no enough scrap in the world to supply for this whole transition or electrification and for decarbonization. We have to come, the majority of the demand and the supply they have to match, we're gonna come from primary. And primary have to find for the miners. And that's the problem. I think even steel, so if you are talking about steel, my view is that China start peaking now on the steel intensity for the economy and the steel production. So we are probably going to hovering around 1.1 billion tons of steel produced. What's going to be the outlook for that? They're going to stabilize the production. They're going to come out probably after 2025 or 2026. They're going to increase the recycling, yeah, because start using more scrap in electric arc furnace or blast furnace, and start producing less pig iron, yeah, and also the demand for iron ore going to come off, and also the metallurgical coal as well. But because China has been booming economically since 2003, and the obsolete scrap start kicking off the collection after 2023, something like that. Because at least the obsolete scrap is going to come to the market roughly 20 years, started building infrastructure in China. So we're going to see only the mass production, collection, distribution of scrap in China. That's not yet a national network for scrap, only 2025. By then, at least for iron ore, steel, there's a lot of demand will come for primary. And they also, all the critical minerals, that we discussed about copper as well, but all the critical minerals, even manganese, nickel, they're going to come, majority comes from primary. So the mining for these materials are going to be critical, and they have to find a place to induce, and the inducement costs have to support by the price of that. So all we're going to tell us that at least to induce this product, the price is going to at least maintain the same level that they are now, or probably skyrocketing. So that's a little bit about the tone on the name of the game. They're going to be inducement cost, new products. They have to meet the demand on the supply side.
No, it's interesting. I want to explore a bit more the copper side, and I mean, could you educate us, Gilberto, about where is copper mostly produced? Outside Chile. Are there any new frontiers in terms of copper production? And how much? Because one thing that I've heard is that coming out of the global financial recession, the global copper supply has increased by 12%, and now this time, it's increasing by only 2%. And to quote, Ottaviano, who's here with us, he said that, in a recent article that copper could be the new oil. So, I mean, are there any new frontiers so people could look for copper, or is it just going to be the case where we could see prices, just skyrocketing?
I think you're gonna probably see some new suppliers from South America. Peru, you're also one of the big producers of copper, and also there are some new products even in Brazil. Yeah, Australia, I know there are a lot of products coming on, and also locally China, they start building new products from there. Other than that, maybe you can find some products in Africa, yeah. But I think depends on all the regulation and setting the environmental issues as well. The ESG is going to play a massive role for all countries, yeah. And I think also we have to put in the balance that these countries, they're going to be massive transformation for them. Would you like to have a very clear framework to set up the royalties, taxes? Because they aim to get benefit for this mining, for their development. So I think Chile and Peru now are even discussing now new regulation, new frameworks, and in order to, of course, attract investors to induce these products, but also benefit the country, the labor, and develop of these countries because of these booming commodities. They are also the countries must be benefit. But I think my views are going to be probably South America, Africa, a little bit some projects in Australia, marginal and very high cost producers in China. Sorry. Other than that, maybe Felix can help me, but that's probably the ones that I oversee.
No, I think you're right, and I think there's the mining and the primary source, but there is then a big industry around the processing of these metals, and on that, China really took a huge, has a huge advantage, and so I think some, countries, but companies and investors should really think about, forcing a diversification, because it's not healthy for anyone to have one country controlling 80% of the processing of critical, very strategic, components such as lithium, and so on. And so I think right now we might have kind of forgotten about that part of the supply chain, but it will create a lot of opportunities for for countries, and the countries that you don't have to be sitting on a reserve to be a leader in processing, because this stuff moves around. And so you can, countries that may feel that they are getting away a bit from this new economy, countries like even even Canada, even Australia, that will probably lose on the oil and gas and on the coal side, can kind of shift, pivot and become leaders in the processing of these metals. And so and just to really come back a couple minutes ago about the recycling, of course it's not enough. The stock needs to increase, but the proportion of metals that will be recycled will just increase. And therefore, the leaders, the companies that already are well positioned in these industries and that have invested, for the last 10, 15 years, will really, we think, reap some benefits. And so some of the companies that I've mentioned, and we talked about some in our notes, are very well positioned, because it's going to go from, I don't know what the current recycling rate is for some of these metals. It's been increasing, but it started from low, and now it's going to go to the maximum possible, just because of the sheer value of those materials. And so the companies that are already well established, that have good technologies, and already all the supply chain set up will benefit from that. So that's a good way of playing this theme without going to the primary miners that sometimes come with some ESG red flags, right? Because mining is a difficult business. It's a disruptive business, and historically it hasn't been necessarily the most ethical business. And so there's a lot of history. So some investors are a bit skittish about investing in primary extractors. So either they try to find the best one, best of class kind of thing, or they just go down a little bit downstream the supply chain, and then still probably benefit at the same level, but without getting their hands too dirty.
Yeah, let me ask you a question, Felix, here from the audience, from Thiago. And it isn't so much to do with commodities, but it's something you talked about carbon, as it really has to be treated as a commodity. Is it time? I mean, of course, we've been talking about this for a while, for a carbon border tax adjustment, so that people don't do. I don't know if you heard this expression, but climate arbitrage. So people leave Europe, where there's a price of carbon, they go produce in China, where there is, where it's cheaper to pollute. How do you see this happening? And especially, the way Thiago has been asking is, you think there could be pressure from companies operating in Europe to the regulator and say, okay, I mean, let's have an even playing field.
Yeah, absolutely. So in the climate space, we call it carbon leakage. So when one jurisdiction has stronger rules than others, there might be carbon leakage, and we've seen that with the steel, the cement industry in Europe, and other. But on the carbon border adjustment, it's I've actually worked on this quite a bit at the time, for when we were looking at it from the Canadian perspective. And at the time, there was big issues at the World Trade Organization, because it could have been seen as some protectionism, to say that you will tax anything coming from outside. But then the rhetoric really changed, and I think now most people agree that it's necessary to do. And so there are already some very advanced talks, obviously with Europe. The US is now, interestingly, like Biden talked about a carbon border adjustment before talking about a price on carbon for their own economy, which is probably reversed. Like you need to have good practices domestically before starting to tax anything coming from outside. But at least it's out there. It's being discussed, and yeah, I think it's inevitable. It will be part of the calculation of companies when they decide where to produce. And on your question about if companies are already putting pressure, I mean they are, and I'm sure Gilberto has some experience. But I've heard ArcelorMittal very loud, saying that they need that, because what happens is the Indian steel is coming, and obviously has a huge competitive advantage if they're not if they're produced in an era where carbon is not priced. China is now starting to price carbon, so we will probably more talk about India for the time being on those commodities. But so yeah, I think it will be complex discussions, because the price on carbon is very different from one jurisdiction to another, and
right.
Whether if they use a cap and trade or a carbon tax is not the same consequences, and so it will be difficult. But it will become, at some point, it will become part of the decision making of companies. They look at the cost of human capital, like how much it is, how much people earn. Like they look at healthcare costs. They look at taxes, of course, and then increasingly you'll see they'll look at the climate risks factor. So the possible physical climate risk, and if they go to in a place that has a highest forest fire risk, that will be part of their, and the price on carbon will be just another factor to consider. So I think it will be part of that mix.
Yeah. I think.
Yeah, go on, Gilberto.
Just would like to make a comment on that. I think it was very, very well captured. I remember that back to 2001, I was part of a discussion panel with McKinsey & Company in Rio de Janeiro to discuss the future of the steelmaking industry. And at that time, there was a very concern about the level of CO2 emissions, not only CO2, but SOx, NOx, related to sulfur and nitrogen as well. And the idea at that time was, okay, we cannot pollute more, and we have a very strict regulation and framework for Europe. So all new products from steelmaking must be divert to emerging countries, because they're going to be cheaper and fuel and labor, and also they don't have much kind of regulated framework for this kind of pollution or CO2. And it was very clear at that time, and there was the idea to build a steel plant in Brazil with partnership with ThyssenKrupp and Vale, and today is an asset bought by Ternium, in a Ternium company. And there was the idea designed, I think, 20 years ago. If we don't have this kind of a tax board adjustment or a level play field for other countries compared to Europe, because believe, of course, they are the most developed or advanced continent on the CO2 emissions trading, and they have this carbon trade already established with very liquidity nowadays. Europe is going to be only a rolling facility. That's all. So we're going to be producing virgin iron, depends on which technology we can produce. In Europe, we're going to have only rolling, cutting, bending, and distribution. That's all. And this have a massive impact in Europe, because steelmaking demands a lot of, and also generates a lot of employment, wealth for the continent. So it's very not easy topic for the industry lobbies, confederations, and also for the employees, tax revenues for countries as well. And they have to balance out. And I remember Mr. Mittal saying in a lot of discussions internally that they must be applied this level play field. Otherwise, for them, okay, so I'm now investing in India. Now I have a lot of capacity in Brazil as well. I'm going to only import to Europe and just rolling, just cutting bands and distribute. So that's the kind of thing that Europe must do, and they have to cut in agreements for level play field. Otherwise, it's going to be difficult to maintain the supply chain and producing virgin iron in Europe.
Yeah, and just to follow up on this, I mean, so as it is, I mean, it looks like India is the main offender. I mean, is that going to continue to be the case? And would they be, the way the question was phrased here is a commodity paradise. So, and then making the point that, could India be what China was to commodities demand in the 2000s? I mean, could China, could India take up that role in the next decade?
I always talk to a kind of a very simple comparison between China and India for clients. So you cannot compare the speed and intensity of a dragon compared to elephant. Yeah. So that's a difference between China and India. I think, of course, if you put everything in perspective to GDP per capita, intensity per capita, we are talking about a massive country, 1.4 billion people, the demand and intensity is going to be completely massive. But we have to understand the culture of the country, the way they develop there, the political organizations, and also the cultural things as well. Because in China, they have a completely different framework set up for political organization. Once the Politburo decides, they have a lot of timelines. Everybody goes in the same direction and done. In India, it's not the same. Just for approve a single law on the value for IVA, IVA in India took 5 years to get approved. So this kind of a complex between the two countries is going to set the tone. Of course, the demand is coming, and interesting enough, India is going to demand a little bit different commodities compared to China. For example, oil probably going to be the two main drivers. No, oil the same; they have to import a lot. But for example, for iron ore, they are net exporters, so they have massive reserves, rich iron ore, so they don't need to import. Especially they have a lot of legislation to protect the reserves, so have rich iron ore, and they only export the mid-low grade. So in iron ore, there will be no big ban on boom for India. Metallurgical coal, this is going to be one of the key drivers, but also have to balance out. Well, metallurgical coal, polluted, blast furnace, they have to set. But it's going to be very difficult for emerging country with a very emergent GDP per capita curve to make this massive transformation without passing through the industrialization and polluting, emitting. So this is something that is not clear for me as well, how these emerging countries, they're going to do the transition that for developed countries is easy, but even for developed, actually it's not that easy, but for the a little bit poor countries, how can make this bridge directly? This is a little bit difficult, especially understanding India. But the commodity set is going to be different for them, even compared to China, like to like. But also, I'm bullish on that, but takes a lot of time. Something that in India, we have 5-year goals. In India, probably going to be 15 years goal to be achieved. It's a completely different scale, but also it's going to be very important for commodities demand and supply as well.
No, thank you. That's excellent, Gilberto. And there's some people asking about oil. So, and of course, you saw, yesterday was a big day, for the world and for climate, with the court decision in the Netherlands, forcing Shell to further, to step up, their cuts in emissions. There are also two activists that entered, ExxonMobil's board. So, I think it's basically the consensus that we have seen peak oil, but are we running? Are these events really positive, or are they just noise? How do you see that playing on, and especially how much of a precedent does that establish for other oil companies?
I'll start, and if you want to add, Gilberto, I think it was a big day because there was in addition to Shell and Exxon, there was also Chevron that saw 61% support to disclose Scope 3 emissions, which the company did not want to do, so they were advising against it, and yet it passed fairly with a big margin. And in the case of ExxonMobil, it's really interesting because it's this very small hedge fund, engine number one, that proposed that they have a $50 million investment in Exxon, which is a $250 million company, but they were able to rally a lot of big investors, and including BlackRock. Kind of helps, right? But it's I think it was a good day for activism. I'm not sure. I wouldn't celebrate too quickly on a good day for the climate, because, I mean, to be honest, the company fought so hard and put so much resources to make sure this resolution would not pass, that it's not going to change, suddenly, because you have two new directors on the board. The CEO, I haven't seen any news yet if he's going to stay or not. That could be the next big thing. I don't think he has the legitimacy to stay. It's a big blow for his leadership. And then you might see some kind of transition, but this is a very long. Like I'm in terms of engagement, when people ask what we think and what I think about engagement in the context of ESG, I'm not I'm not that strong on it. I prefer divestment. I prefer shorting companies. I think the message is a lot stronger when you take capital away from a company than if you really go slowly and you try to make them progress very slowly against their will, because that is the case for Exxon. And it's not like if there are no oil majors that are more progressive. There are some. They're mostly in Europe, but there are some that are really thinking about the future and of the transition and are writing off some of their reserves. And so I just don't understand why a ESG investor would spend so much energy on trying to convince probably the company that had the worst impact on the climate in the last 100 years to change. At some point, I think you need to cut the ties, move on, and find a better horse. And there are some. And so that's my very maybe cynical view on the events of yesterday. But overall, obviously, I'm happy that it passed. I'm also even happier than big investors like the BlackRock of this world are now having the courage to basically support these kinds of resolutions from the common investors.
Fantastic. So do you want to add something, Gilberto?
Yeah, I think I would like to make some kind of a parallel or analogy for the mining sector. I think everybody knew about the big environmental issue. We have an accident in Brazil 2 years ago. And after that, a lot of activists from the Church of England to ruling out, to set the tone, especially because a lot of mining commodities in companies that are listed in London or have distribution in London, a lot of hedge funds, and they took the leadership on this discussion about the tailing dams. Yeah, I think I participated in some meetings from the ArcelorMittal side, because ArcelorMittal, a little bit, of course, they were concerned about the tailing dams. They have mining assets in Brazil. Yeah, and these trigger a lot of legislation, new frameworks, and driven by the big investor, and coming down, cascading down to the executive level, and see, okay, what's next? What do I have to do in order to not only internally, you see as an executive, we have to tick the box. Yeah, no, we have to do this framework, we have to produce these slides, we have to talk to investors. So we are doing something, we have a plan, we have deadlines to go. But of course, on the board level, the investor are going to rule out, okay, you are doing the proper job. You have the most capable guys in the world to run these new projects, especially to clear out and change technology, invest for the new tailing dams, because they're going to be required, change technology, investment. And there was a lot of activism for mining sector, specifically for iron ore and Vale because of that. We're seeing a lot of Vale losing value because of the accident, and also for the time that accident happened up to the end of the management to put in a lot of efforts, talk to investment, presenting the plan, and then this transition for the tailing dams. Now there's a new company, a new setting the tone. They change all the management, and it was a pressure from investors, and big investors like Church of England, but also a lot of big ones like big Black Rocks and all the big funds. And it's the same. So I think we're going to see even more. Right? I didn't know this information. Very, very nice to see a hedge fund with $50 million invest for a multi-billion-dollar company with EV. They are changing the mindset. So I think we're going to see probably more and even more in both oil and mining. And I think the top executives and the directors, they have to be clear, because they have to do a lot of things and to be compliant. That's a little bit comment from my side.
Yeah, and there's also the flip side to that, which is, instead of attacking supply, because what you see mostly in the developed world is people trying to attack these companies and attack supply, but maybe there should be more to attack demand and people changing their lifestyles, I hope people begin to understand that, and because going to a carbon neutral economy is going to involve a lot of things, like such as eating less meat and so forth. So how do you see, Felix, the kind of the balance between the attack that is being done on especially from the rich world on supply, and with the vis-a-vis how much reluctance there is to change demand?
Yeah,
and do you see people really willing to change demand?
Yeah, that's a good point, and that's something we see a lot. People are saying, "Oh, we want our government to have more regulations for the bad polluting industries." But while they're saying this, they're not changing anything on their lifestyle. They are eating the same thing. They're traveling by car and by plane, and they are. So it's always easier to blame or to say that it's not, it's the government's role, or it's to regulate. It's a lot harder to actually implement changes on your lifestyle that can do that. I think, and none of us are of that generation, but I think that the next generation and the following one are probably more inclined to take a bit more responsibilities on themselves. If the psychologists are good in their assessment, it seems that they that with the change of generation, taking the millennials coming into decision making roles and stuff, we might see a little bit more of that change, because they I think they take more responsibility, and they are willing to disrupt their own lifestyles for a better common good. And so that's encouraging. It's still, we're seeing it in the investment world. There's every year there's an increased demand, even at the retail level, that the people want their investment to be better aligned with their values, with ESG criteria. And so that's one part that even though we believe and we've demonstrated that you can actually make more money possibly investing in that, people are even willing to give a little bit on performance in exchange for investments that are more aligned with their values. And so I think that's a start. You'll see the electric vehicle case study is a good one. If you go back to 2010 or so, and you look at the projections of how many electric cars would be sold by 2015, 2018, 2020, 2022, they were wrong every single time. They were wrong, and they were it doesn't happen that often, but in that case, they were estimating the number. So it's actually being more popular. The change is happening faster when you see that Ford is kind of coming on board with an electric F-150. You realize that there is there's hope on that front, and that change can happen very quickly. And I'll just end my comment on this. There's a good Bill Gates quote that says that we tend to overestimate what we can achieve in the next year or two, and we tend to underestimate what we can achieve in the next decade. And so I think that's right, because there are some big revolutionary events that happen, and then the pickup can be extremely quick. And so unfortunately, we don't have that many decades between now and when we need to be at zero, but there are a couple, so we should make the best out of those.
Fantastic. And touching on that, I mean, I have a question for both of you. I mean, I'd like to hear what both of you say, because Gilberto said at the beginning, he mentioned the IRA report and what needs to be done. And a lot of people talk about uranium, and they say that, a lot of people say it's impossible to get where we need without nuclear power. So, I mean, I'd like to hear your opinions on that.
Yeah, well, I'm not so a specialist in uranium, but I tend to agree. I think we have some discussions at group level. Actually, back to my BHP time in Singapore, the demand for yellow cake gonna be probably have to grow a lot because there are a lot of projects coming on the next 10, 15 years, because I think we cannot rely on not stable enough technology for wind conservation, and plus the solar. We have to get to the grid some stability. We cannot rely 100% on batteries as well. We have to be relying on a 24/7 energy production. Yeah, not only depends on the weather or sun or something like that. I tend to be a little bit more bullish on uranium because of this. Of course, there is a lot of concerns if it's safe or not, but tend to be proved to be a very safe technology. Yeah, we have some, of course, big events. Yeah, it's not easy to have an event, but of course, when it happens, it's massive. Yeah, but the probability is very low. And so I think uranium demand is going to continue to be growing, and also requires a lot of mining as well. And I think on the mining side, I think US and Australia, they are one of the big ones producer. So I think uranium, yes, I believe there could be a demand growing for the next 30 years, I think.
Yeah, same here. We're very bullish on uranium. We actually have Cameco in our portfolio. I think we can't do without nuclear. I'm not sure if it's for the same reason as Gilberto. I think technology will probably find a way to balance the grid with renewables and stuff, but that's not even like, we still need all of the above strategy for addressing the race to net zero. And so I think the reason should be that it's an option. It's on the table. We know it's technologically feasible. It's a political hot potato. There's that's going to be the big issue. Will be the approvals of new projects, because it's always politicians tend to be a bit skittish about that. But what we're thinking, and we are actually studying some investment ideas around the companies, engineering firms that are specialized in the refurbishment of nuclear power plants, because we believe that instead of doing kind of greenfield projects, there will be a lot of extending the life of existing And so in France, for example, there are some of their power plants are coming in the next decade or so to the end of their supposedly their economic life, but instead of decommissioning them, we believe that it's a lot easier from a political standpoint to approve an extension than to approve a greenfield, because then you don't have to deal with the NIMBY effect and so on, right? And so also there are different ways to play the nuclear theme, but I think uranium is a good one. The engineering services is a good one, and then the utilities is a good one as well. And so we've actually written a note just a few months ago on that. So if one of the listener wants to have access to it, I can share, and happy to do. And I think it's not that much of a popular topic among ESG investors. It's a bit of a radioactive topic, but it's I don't think honestly we can do without. And for those who read the Bill Gates book on how to avoid a climate disaster, he's also extremely bullish on nuclear, even going to the nuclear fusion technology. So investing in, which I don't believe will be ready or economical in probably my lifetime, but still we need to advance the technologies.
Fantastic, that's great. So we have 4 minutes left. So I would ask Gilberto and then Felix in 2 minutes to summarize their main investment recommendations. So I mean, how do we make money? So should we just stay long the commodities and the mines? I mean, and is there anything you'd like to highlight? So let me go with Gilberto first.
Well, I was discussing with some clients, what are going to be the most interesting investment opportunity from the mine side. So I think focus on the suppliers. I think we have to go through the cost curve and select the ones that have to be placed in between the first quartile, second quartile, and they're going to be most benefit for the steeping prices to induce a lot of products. So like I talked at the beginning of our conversation here. So on talking about these specifics, and I like pretty much companies that have a very, very strong governance on that. They have very low cost and expandable projects, and they control the assets. Yeah. So I like this kind of very simple criteria, and also focus on the commodities that are going to be demanded. For example, copper, I like a lot, even if of course it's a diversified commodity producer. I think BHP, because is leading in producing, expanding Escondida, the biggest one in the world. I think it's a massive play, because also not only good on copper, and also they have investment in nickel for Nickel West in Australia, and of course they're going to be an interesting position for the long run as well. So I think BHP, I like as well the business case. Margins are good, very good management. They are investing a lot of new technology for carbon capture to help their steelmaking process customers in China, in Japan, Korea, Taiwan, to go through this transition. That for me, one of the key diversified ones. From the iron ore, I like Vale, the business case. I think the management has been making a massive transition and massive turnaround the business since the burst of the tailing dams, moving around and back to producing low-cost, high-grade material for iron ore, and also now envisaging change a little bit the portfolio, focus on copper and nickel as well. So I think it's benefit for the commodities man for the transition. So I think the top one that I have in my mind to be very good exposure for low-cost quartile and high-grade material be BHP and Vale from the mine side.
Thank you, Felix.
I'll go very quickly because we're already at the hour mark. But I tend to agree mostly. I'm still holding on Vale. I'm still unsure. But just to take another strategy, I would use the analogy of the who made the most money during the gold rush was not necessarily the one trying to find the gold, but the ones that were selling the picks and and shovels, right? So I'll just talk about that sector a little bit. So I like the recyclers, because it's gonna continue to grow. They've invested a lot in technologies, and so they are well positioned. I like anything that deals with the water purification that goes, the technologies that are needed on mines. So companies like Xylem and companies like that have good technologies for that, and some engineering services as well that work with the mining and the energy sector, like the SNC-Lavalin, the WSP, the Stantec, so big, large engineering firms. I like aluminum. I think aluminum is really interesting in the objective to make anything lighter. Obviously, aluminum has a huge role to play. So companies like Norsk Hydro, Rio Tinto is in the aluminum through Alcan. So I think these are good companies. They have a big issue with, these companies will face the issue about the recycling business that will take away some of their business. So actually investing in the actual commodity of aluminum makes a lot of sense as well.
That's fantastic. So if you could send me the names of these companies, then I can share with the audience. But we're just over the hour mark. I'd like to thank you very much. It was a great, and I had questions for another 2 hours. So of course, we can have other tracks. But there's a lot to explore, related to that theme. So thanks again, Felix. Thanks again, Gilberto. It was great. And thanks for everyone that was with us. Thanks for your questions. And I hope to see you soon.
Thank you so much. Thanks,
Cheers.
everyone.
Bye-bye.
Thank you.